Today, Samsung announced a plan to launch its Galaxy S3 smartphone in the U.S. market. The Portuguese government said it will inject up to $8.3 billion into three of its largest lenders in an attempt to strengthen its banking sector. I'm Lindsey Bell, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsey Bell with theStreet, and together we bring you the morning call. On Friday, we saw all three major indices in the U.S. end down more than 2% for the day. That was the kickoff to June. But the big part of that was the jobs number that we got on Friday that was weaker than a lot of people had expected. It was pretty bad. We kind of got a warning from ADP the day before, but I mean, it's just showing that U.S. data is slowing here in the U.S.
Yeah, I think a lot of people finally accepted the fact that, the denial became the reality that we are affected by the problems in Europe, that our corporate earnings are starting to get affected. We saw that with Cisco, we saw that in Staples, we saw that in some of the cloud names. And, we've obviously seen the headlines starting to add up. And last week, like you said, ADP was down, claims are up. So why would the jobs number be good? And then I think that number on Friday was just a big time reality check, and a lot of people just really started to throw in the towel right there.
And then on top of it, like you mentioned, Europe, we kept getting more and more headlines out of there from Greece and Spain, worry about the banks over there.
I think starting from the elections that took place a few weeks back, I think that's when I really got bearish. When all of a sudden Sarkozy got voted out, and that made France a commitment to nothing. They said, okay, I'm going to go away from Germany. I want to tax and spend. I want to promote growth. No more deficit reduction. Then you also saw Greece come out and they voted saying, you know what, thanks for all you've done for us, but the money you lent us, the haircuts we decided on, we're not going to pay anyone back. So right there, that was an inflection point. And inflection points in the market, you have to look at them, you have to evaluate them, and then you also have to make decisions on how to manage your portfolio, because there have been sell signals along the way, technically alongside a lot of the headlines that we've seen been coming in the past few weeks.
Yeah, and why don't we just get right into the sector spotlight, because we want to take a deep dive into the S&P. On Friday, it passed a 200-day moving average, a level that it hasn't seen since December. So what levels are you watching?
See, a lot of people on the Twitter sphere all around like, now what do I do? I'm like, what do you do now? I'm like, if you miss a lot of your signals and now you're in a tough spot. Okay, if you remember talking through the first quarter, we were like, okay, the market's following the 10-day moving average. You could buy it each time. It's following the 20-day. It happened a few times. You could have bought it there. But then within the last month, there were numerous sell signals. If you go to the chart of the S&P, you will see that, after the first quarter ended, it started getting choppy all around up here. Okay, and this was your first sell signal when it broke this ascending channel. Okay, and then, we came in, retested, and at this point, you saw this pattern develop. I talked about it so many times, this head and shoulders top, the left shoulder, the head, the right shoulder. Right here on this day, guys, look at the May 4th. May 4th, the S&P closed at 1369, so 1370. This is when IBD put the market back in a correction. All right, from here, we then went from 1370 down to 1278. So, we went down, Lindsey, almost 110 handles. And I got some emails saying, well, I'm not a day trader. I can't act so quickly. What do you mean you can't act? You saw the pattern. You saw it go into correction. You're allowed to sell stock. You're allowed to go to cash. Even if you're a long-term investor, that's why we say on a macro level, yeah, go to at least a tier 1 or be protected. Because when the complexion changed, you have to change. And if you go back to that pattern one more time, you will see that the measured move right here from the 1420 to about 1370 took us down to this 1300. Then it tried to bounce. Okay, you tried to develop some type of pivot area, and it was a bear flag. We talked about that on Thursday, where here's your pole, right, from the highs to the lows, and it couldn't take back more than a third of it. It was a feeble bounce. So here was your continuation to the downside. If you sold as we went through the 200-day, you sold late, but at least hopefully you feel a bit more comfortable, because the last thing you want to do is be jumping out of your skin all summer long.
That's right. The S&P 500 is still up about 1.5% for the year so far, but as it goes more negative, if it goes more negative on the back of all this broader economic news, do you sell into that, or what do you do?
Well, again, I think a lot of the sell signals already happened. We can go down another 5%. The question is, do we bounce from there, and then how do we recover? Now, on Thursday, I threw out 1255. on Bloomberg. I said, even before the melees, I said, you know what? I think the summer lows aren't in, and we could hit 1255. And I want to show you what I used in order to come up with that, because it just wasn't out of the back of my head here. As technicians, we have certain tools, and at different times you want to use different scenarios. And for the Fibonacci retracements, that's what I started to look at. First time we came in off the highs here, we held the 38.2% retracement. If you look, this is where we held, around 1293. From here, it was also the measured move. That gave you a bounceable or a tradable area. And you know what? It didn't hold. So now the 50% retracement is 1251. So if you go here, you see, A, this is where we broke out from late December. So you have a lot of congestion here, a few points of reference. And B, you have 1251. So the way I do it is because of all the black boxes out there and all the algos that are now programmed against technical analysis. You can't just have a point. You can't be 1251. So that's why I'm writing, I think 1245 to 1255 is an area that if we see it quickly, because if we don't see it quickly, then all of a sudden we don't get as oversold as we could be. If we see that quickly, which would have been great with the futures down 10 handles or 12 handles, it could have produced a buyable area for a bounce to retest a 200-day. Right now we're flat, so the question now is you want to look at this chart and see, what type of little bounce can we even have today. So I would say the longer we do stay below the 200-day, which is right now at 1284, I think they might even push the envelope a little bit and try and retest the bottom end of this, which comes in around 1295. The higher the probability we at least see 1251, and I don't think you could rule out this level at some point this summer because it's only June and bottoms typically don't happen to August or even the fall.
That's kind of a dismal outlook there.
Depends on what side of the market you are.
That's true. What about the weekly levels? We've been talking about the daily levels. Can we take a look at the weekly chart?
Yeah, well, that's interesting to see because I think there were all these reports last night about devastation, and like you said, Lindsay, we're still 1% up for the year, or maybe a little bit less. So if you go to the weekly level, you will see that we truly haven't pulled in that much. If this was the 2009 low, let me get rid of this so you can actually see it a little bit more clear. This was just the pull-in, so we're just 11% off the highs. So if you look at the weekly level, this does not look so off base here, right? This 1255, and then even this doesn't look so off base. And this was actually the 61% retracement. And then, if this holds, I think on macro level, the macro investors will still be, I think pretty constructive. But we need to see how we get there, and it's going to be a long few weeks.
And then just another way to look at it is the monthly. May for the month was down 6%. The market was anyway. It was the first down month for the year. So what are the levels of support in May or in June that we're looking for?
Well, if you just want to get a bigger picture, because everyone trades with different time frames. If you go to the monthly chart, we've talked about this. Just say the trend, and we did this on conversations on Stock Twits to show how we could still pull in and still be fine. You still have, here's your somewhat of a double bottom, right? This was that outside move on 2009, and then you had it again. Okay, now you have a low, a higher low, another higher low. So really, we could pull into this even 1200 area, and that would be another higher low. Okay, and you could even, I hate to say it because look how close these were. We could get a little bit more devastation and even come into this moving average at 1141, and the macro bulls will still be okay. But anything below this, or if we take out this area at some point, I don't know when, it could be into the fall if we see some type of 2007 to 2008 phenomenon. This is when really the macro, this is probably when people will be screaming sell, and you missed out of a lot of opportunities. So at this point, there were some people that already said, we're going to go to 666, we're going back below, we're going to go here, we're going to go there. You have to have a plan. You have to have areas mapped out, and you have to do what's good for you. Right now, short term, 1245, 1255, and then you have that lower pivot. And then, we'll get to those areas, and we'll talk about whether or not the headlines are changing, what if the Fed did something and how we reacted to it, what the data looks like. So at this point, if you're in a lot of cash, which we've said at least 75 to 85% cash over the past 2 weeks, it doesn't matter where we go because you have the opportunity and the luxury to embrace the correction instead of holding your nose and going underwater like some people who ignored the signs.
Well, we're going to take a quick commercial break right now, and we'll get into more commodity type plays and some stocks later on.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Let's get right into the trenches with gold and some commodities. Gold on Friday closed at its 50-day moving average. It got a nice bounce, but how important is it for gold to maintain that level?
I think a lot of people have been frustrated with gold, both longs and shorts, even recently, because everyone thought, oh, if everything goes into turmoil mode, gold could be good. But for the past, I would say, month, gold has been on the same page as oil, where it's been seen as a deflation trade. It's been seen as a growth slowing trade to the downside. And then finally on Friday, when everyone really started to get worried or scared, you saw oil continue to the downside, but you saw gold ignite, where it tried to change character, tried to go from deflation, growth slowing, to maybe lack of faith in any currency out there, just a safe haven. So we could see if that continues. If you look at the chart of GLD, you will see, we talked about this level so many times, this 148 1/4, 148.5, and it held in really strong. So this level hold. This was the pivot low back from last December, and you did a triple bottom there, which is surprising, but it did hold. So if you look at the big picture here, there are a few different trends to draw, a few different big lines it's going to have to deal with. Here's one line, and then here is another. Okay, so right now you had an igniting bar. People want to trust it. People want to stay with it. I'm long it. I would say you take a closer look here. In order for this to really continue to the upside and have the momentum / pent up bullishness, is you want to see this gap hold. And you want to see it go pretty quickly. Maybe it stays and digests for a day or two. So I would say I'm going to be long gold and stay with it as long as it stays above this 154.87. Okay, and then if it can go sideways, I think the next area you add to your GLD would be when it takes out Friday's high of 158.31. Then the next level is going to be this intermediate downtrend, which it hasn't taken out yet. And you know how many times we tried this here and failed, and that's going to stand right around 159-ish. So I think the next thing for it to really do is clear 160 with volume and do it quickly in order to, put some pressure or some trust into buying gold, because right now it started, and let's see if it can continue. And I'm not going to be stubborn. I'm going to say that, you know what, I'll stay with this. This is my line in the sand. If it continues, I'll stay with it if that's what the market wants to do. But if all of a sudden it goes down today and then starts going into the gap, everyone that flocked to it on Friday will flock out of it, and there's no reason to be there if the market doesn't show the commitment.
So you need to know your levels there. How about silver? Can this one go higher?
I think I'd rather people stay with gold. Silver usually is the tail that wags the dog of the metals trade. Sometimes it outperforms based on where it is. If you look at the chart of silver, you will see, there's actually a pattern here. I might actually take a look at this because there's something clean cut. It also held the lows from December. It actually held a little bit above it. So it's showing, a decent sized divergence where gold was testing it. This held above it, and now you have this little ceiling here. So I would say for a trade, if you did get in silver on Friday, the next trade is when it clears this 28 area on volume, and then just like gold, you can have some resistance. 29 is going to be resistance. You have this intermediate trend that comes in here. So really, for this to be more than just a 1 to 2 day scenario, it's going to have to start breaking some trends. And here's level 1, here's level 2. In the next few days, this could be a good active trade, but then for a macro trade to develop, it's got to break above 29, hold above it, and continue.
The euro, we've gotten so much bad news out of there, and it's gotten really beaten up. Could we be bottoming in that one, or could it eventually reach parity with the dollar?
I do think that someday we can reach parity, and that's not so far off. It's been what's been dictating the tape, and it's actually dictating the futures last night, because as soon as some of the overseas or European indices started to show a little bit of life, our futures went from down 12 to only down 8. I think right now we're up a little bit. And if you look at the euro, these things still trade. They don't want to give everyone free money, and they've paid the shorts very handsomely. So if you go look here, you will see overall on a macro level of the chart here, look where the euro is from the peak that you saw here on this outside day. Look at this outside day. Now that you look at it back on May 4th, pretty, it's showing its face. And then here also, you had the same type of thing where, it couldn't get back above. And then you had this, huge, what's this called, an island top, where you gap up, then you gap down and you trap everyone. So that was another sign that the euro was going lower, and it never filled it. And then recently, you had this pennant here, right? A pennant that wound up resolving to the downside when it broke below this 130. So the question is, look where we are now. You know, you go and take a quick look on a short-term basis. You know, it did try and, you know, I guess hold in there on Friday. So now at this point, I would say watch this little area. If the euro were to start getting above, just say 123.96, you know, there is some room to bounce, you know, to this moving average, maybe to here if that's the case. You know, the dollar goes down and maybe you do see a reflex move in some of the indices. But so here's resistance 1, 2, actually this is 1, 2, 3. So this is the bounceable area. But if you do go to your monthly chart, you will see that overall, you know, it's definitely in a downtrend here. And at this particular point, it's actually here you can see a little bit higher. But anyway, if it starts taking out the recent low here of 122.75, your next point of reference is 118.79, and then here where it originated at 118. So this is major right here. So that's something on a macro level you can look at. Micro, look at this recent low. Macro, there's your big support.
The European slowdown has also weighed on oil prices. We've seen that come back quite a bit. But is there any catalyst near term for that? I mean, it's been a rough play.
I think oil's a bit oversold. It's like 81, 82. It could bounce a little bit. People are saying that this could be positive for the U.S. consumer, and I think it can. But again, 80s are good, 60s are better. And if you look at the pump, somebody should get some regulators to these gas stations because oil just got crushed and gas might have went down, you know, 20, 30 cents. So they're taking the sweet, you know what, time in order to get gas down to give the consumers an actual savings. So we'll see what happens from there. As far as oil, let it bounce back up. I don't think it's a compelling long here. It's just hard to be short after a move from 100 and change down to the low 80s. So just watch it and we'll see what type of action we get if it warrants any more attention than just an eyeball.
Let's do some quick hits. We'll start with Apple. It's been a name you've been watching, high beta tech name. It's actually been able to do a little bit better than the market, but on Friday it kind of got a little bit weaker.
Well, I think on Friday they just started to throw in the towel on everything. And you know, the last 2 weeks Apple's been a great trade. In a market correction, you pick the right stocks, you could actually make money also. We talked about buying it at the 100-day, adding to it through 574. And then really what happened was it broke above that level on Wednesday, Thursday-ish. And the market just didn't follow. It didn't ignite tech. It showed you how weak the actual market was. That's why when I sold it on Thursday, everyone's tweeting me, I thought you said Apple can go to 600. I'm like, you know what? A, on the swing, I'm up about 40 points, so I'm taking it. B, on the cash flow trade, I just don't like the market, so why be in anything? So if you look at the chart here of Apple, you will see that here is when it held the 100-day the first time. Here is when it recrossed and traded above this, you know, 543. Okay, and then it did hold it right this area and went sideways a little bit, and look how choppy this became. So you know, on this day, I actually sold it, you know, and it closed no highs, and I was fine with it. And then where it was like one of the, actually no, it was this one, I'm sorry. It was on May 30th for compliance. I have to give you the right day. It was this day, Thursday. And then you had a nice short. Guys made some money short here on Friday. And now, you know, this small ascending channel has now been broken to the downside. Today, futures are up a little bit. If Apple trades below 560.52, there will probably be guys that short this thing. And then next area support really doesn't come in play until 553. And then who knows, maybe it touches the 100-day. The first time the 100-day it held was 527. Now it moves up here. So for me, I'm just back to cash flow trading until I see more clarity in the market. And right now, watch this short-term pivot, which is 560.52. Trades below this. Here's support 1, and then here is your 100-day.
JP Morgan, it's been struggling since the trading debacle news came out. What are the key levels there? Can this one start to gain momentum or at least stabilize?
Well, momentum and JP Morgan probably aren't going to be in the same sentence for a while.
Right.
And once the news came out, it had to be take JP Morgan out of the picture and trade a level versus a level. And if you did that, you know, you saved yourself a lot of money. You could have tried it a few times. I tried it a few times and lost. But I didn't say I'm going to just buy because it's JP Morgan. If you do something like that and have a thesis, you can get put out of business. You know, obviously JP Morgan longer term, you'll probably be okay. But we saw that in other stocks like Zynga, etc. So hate to put them in the same sentence, but anyway, go to JP Morgan's chart, and you could see, if you remember, you know, after the news, you had your gap down and tried to stabilize. This was your first tradable pivot. But then when it crossed this 35.76 on this day, you got out of the way. And then it tried to do it again. Here was your recent low. It tried to, hold support here. It tried to put in another tradable pivot. And then on Friday, it broke below. It broke below this area. So if you're following those rules, you get out when it breaks 32.26. So now today, you could say 31.77 is the new area to break or trade against. But on a macro level, it trades below there. I do think now at some particular point, JP Morgan's going to be retesting this zone. This is 30.42 and this is 28. So, for I think value guys, or for me to tell my mom to buy JP Morgan, or my dad, I think it'll be more in this 28 to 30 area versus right here, which is a little bit of no man's land.
Caterpillar is an industrial stock that's been showing some relative weakness. So
it's been showing relative weakness for a while, and it shows you once you break your 200-day, I don't care what the name is, you get out of the way. And typically, historically, stocks break their 200-day, there's more downside to happen. That's why we said with the market, we broke below the 200-day, the longer we stay below it, the further down we can go. And if you want to put Caterpillar as a gauge there, Caterpillar broke its 200-day right here, right? This is when it broke its 200-day. So if you were late to sell Caterpillar, okay, right around 100, you still saved yourself 15 points, because the time to have sold this stock was well before. It was at least, right around here, around 99, or even when, it broke this area and started to continue this downtrend or confirm this downtrend of high, lower high, lower high, it broke support. So anyway, at this point, it's still in no man's land. I've tried to play it for a bounce a few different times. In this area, it tried to hold, but showed no relative strength. And now it's, I guess low here is 84.72. This is just, it's a hard stock to short now, but it's also a hard stock to buy until we see some more clarity in the market. And here, this 80, I would say, is a big level. And I guess it's already sort of traded through this. So at this point, Caterpillar is not one to turn to for more than a trade until we see some type of bottom pattern. I guess if you're a fundamental investor and you have a long-term approach, because I'm sure at some point it will come back, it is Caterpillar, then I would say be in tier one if that was your macro position, and you didn't get stopped out, then it's fine. But don't add to this thing until we see much more clarity and see some type of real reversal pattern or better complexion in the overall stock market.
Yeah, you can possibly get it at a better price. How about Facebook? It's everyone's favorite name to talk about. It's back below $28. Where can it go from here?
Facebook last week wound up being a nice reversal long. I wanted to target it between 26 and 28, and we did. And it was a nice trade, I believe, on Thursday. I held some because I said, you know what, I try and put a strategy out there where, the red dog reversal, you hold for a trade, maybe a day and a half trade, and sometimes, it's a pivot bottom versus support. So Friday, while I wasn't in the office, I actually held it and said, I'm going to give it to the lows of this previous pivot. So today, Bernstein came out and downgraded it. So, that's probably not going to help. It was down like 40 cents. This was a strategy right here when it broke below this low, okay, and then closed strong. That is a trade I'll take each time. I sold probably 75% of it on the close, made nice money, held 25%, and now I'm sticking with it until it breaks this area. But if it does break, okay, this low here, 26.83, I will be out, because who knows? This thing could go to 24, could go to 22. It has no history here. There's nothing to the left. So use this as your pivot. If it holds it, I will stay with it. And then if the market gets any better, maybe it'll create some type of pivot that you could add to. But for right now, I'm in tier one. And if it breaks the lows, I'll get out of it and I'll lick my wounds and I'll say that was the strategy, and I stick to my strategies.
It's always good to stick to your strategies. And so there you have it. We gave you our deep dive into the S&P 500 and the key levels to watch there, commodities, how to watch those, and some key stocks that you should keep your eye in. So tune in at the end of the day to check in with Scott and the T3 Live team to get the daily roundup.